My name is Monique Madan, and I'm the head of financial life strategies at ETF Capital Management and UPotential. I hope you're enjoying these shorter, more easily digestible webinars. We're actually calling them Ted-inars. Today I'm going to try and respond to some questions that have been posed to me about RESPs, and they have been submitted by some listeners. Just before we get started, the same housekeeping item I've been bringing up each time we speak. As with all recorded matter, of course, this information is current as of the day that it's being recorded. This session, as I mentioned, was prompted by some questions that were posed to me recently by a frustrated client. She was trying to withdraw from her son's university RESP for tuition, room, and board. And the client basically looked at me completely dazed with all the acronyms being thrown at her. She was being told about RESPs and CESGs and AIPs and EAPs, and these terms were being hurled in her direction, willy-nilly, and she had no concept. The client also mistakenly believed that the RESP was designed to reimburse her each time she spent money on her son. So she was remitting receipts to her financial institution. In fact, these accounts are not designed to be an expense report like you might submit to an employer. The actual amount that you withdraw from the RESP doesn't need to match the cost of tuition and the associated expenses. So let's clarify some things. The RESP is the account into which you've contributed funds. Then, if the beneficiary is eligible, the government will match your contributions with grants called the Canada Education Savings Grant, and that's up to 20% up to a maximum of $2,500 per year for a maximum grant of $500 each contribution. Then, when you're withdrawing the funds, the EAP, or educational assistance payments, are what your child would receive plus your own contributions. Lastly, the AIP, or accumulated income payments, are the excess investment income that you, as parents, could withdraw if your children don't need everything you've saved for them. To be fair, I don't see that all too often. Now, believe it or not, the financial institution that you're working with to create this RESP has to keep track of all these different parts. How much you contributed, how much the government's contributed, and how much has grown by way of investment earnings. Because there are limits to the amount of the contributions and grants that each beneficiary is entitled to. And not everything that your child withdraws is going to be taxable to them. My goodness, no wonder RESPs are so complicated. The taxation of RESPs is also full of rules. Simply put, your own contributions, sometimes referred to as the post-secondary education payment, is not taxable upon withdrawal because you didn't get a tax deduction when you put the money in. What is taxable is the combination of the Canada Education Savings Grant and the investment income. So when you request a withdrawal from an RESP, you can request any amount provided that you submit proof of enrollment. Now, I'll only speak from my own experience in covering our son's expenses, but it's pretty easy for him to print his proof of enrollment directly from the student website on his university website. Now, in the first 13 weeks of study, your child is limited to a withdrawal of $5,000, but after that, there are no withdrawal restrictions. Most of the time, parents choose to spread the withdrawals approximately evenly over the period of study, let's say, over the course of 3 or 4 years, but you can withdraw in any way that suits you best. Just remember that the CESG and the investment income are taxable in your child's hands on top of whatever other income from part-time employment they already have. The most difficult part of withdrawing from an RESP is advising your financial institution how much to withdraw from each of the three distinct pots. You know, the refund of your contributions, the Canada Education Savings Grant, and the investment earnings. I usually recommend that clients start by withdrawing a mixture of the CESG and the investment earnings. In the case of the CESG, any amount that's not used has to be repaid to the government unless it's used by a sibling. With regards to investment earnings, any amount that's left over after your child has completed their studies can be very heavily taxed in the hands of the parents. Now, to fine-tune the strategy, I recommend that clients also give some consideration to the child's personal tax exemption. As you may know, every Canadian can earn a certain amount each year without paying tax, and that's referred to as the personal tax exemption. The federal amount differs from the provincial amounts, but for the purposes of this example I'm going to show you, let's use a child living in Ontario. For 2022, the personal exemption in Ontario is $14,398. And let's say that the tuition that we have to cover is about $7,500 for the year, and residence costs a further $15,000. So your child is going to need, in this particular example, about $22,500 to cover all the costs. So let's work backwards. Your child's going to need a total withdrawal of $22,500. If we try to limit the taxable portion to the personal exemption of $14,398, I would recommend that you first withdraw $5,000 in CESG to make sure that you don't have to repay it to the government, and then take $9,398 from investment earnings. This way, the taxable withdrawal is less than the personal exemption, or in fact equal to the personal exemption. But your child needs more. So the balance of $8,102 should come from your contributions. In this way, you've covered that year's total costs and paid no tax. Remember, you don't need to show the financial institution the exact amount that the tuition, room, and board cost, simply proof of enrollment. This means that as long as your child's studies qualify for the RESP, which by the way is determined based on the type of educational institution and their course load, then you can use the funds for transportation, food, lab fees, or any other expense during their period of study. Again, you're not being reimbursed. You are withdrawing funds that you have set aside for your child's period of study. Now, if your child earns their own money, perhaps through a summer job or internship, you'll want to adjust the taxable portion of the calculation accordingly. So for example, let's say they earn $3,000 from part-time employment or a summer job. In that case, they still need $22,500, but you'd want to reduce the amount of the taxable portion to accommodate this other piece that will be taxable in their hands, and in order to, again, stay within the personal exemption. In this example, we would want the taxable portion of the RESP to be only $11,938 because of the child's summer earnings. If we keep the CESG the same, we should reduce the investment income withdrawn by $3,000 and then increase the amount that's withdrawn from return of contributions. They still receive enough to cover tuition, and it is still tax-free. Now, as you may know, the tuition tax credit of up to $5,000 can be transferred to a spouse, parent, or grandparent of the student. The important issue here is that the credit must first be applied to bring the student's taxes payable to $0. But in the previous example, we covered the child's tuition with no taxes owing, in both the example of the child who actually doesn't earn in the summer or through part-time earnings and the one who does. So if the child owes no tax, then the whole credit, the $5,000 credit, can be used by the parents. A lesser known strategy is that the use of RESPs by adults for their own continuing education. You see, you can open an RESP for yourself as well. Now, you wouldn't be eligible for the Canada Education Savings Grant because that's only payable to minors. But if you have an interest in studies later in adulthood, you can contribute to a tax-deferred account, which you would then withdraw from later in life. As long as you're using the funds towards courses that are approved and you can provide proof of enrollment, your own contributions are returned to you tax-free, and you only have to pay tax on the investment earnings. Now, I have to say that I really think this is quite elegant, because I actually think it would be really nice to spend a semester, let's say, at Princeton or Oxford in early retirement. So maybe think about it. Thank you for your time and attention today. To share questions, comments, or ideas for future webinars, please contact me by email at monique@upotential.com. And if you want to see how UPotential's planning services can help you reach your potential, visit www.upotential.com/service to get in touch with me.